Group here in Portland, Oregon. Thank you for joining us for today's webinar on the impact of the COVID-19 virus on your retirement plan. A couple of notes. Today's presentation is really oriented for plan sponsors, so we're going to talk a lot about a myriad of issues that would impact qualified retirement plans in the current environment, both investment, operational, and from a vendor perspective. Some housekeeping items before we get started. We have muted all of your lines for call quality. We're recording today's presentation so that you'll have the opportunity at a later date to go back and take a look at it if you'd like. However, we're trying to make this interactive. We'd like to get as many questions answered as we can during the short time we have together. So to the extent that you have questions over the course of today's presentation, I encourage you to use the Q&A methodology within the Zoom application. We'll try and answer those as we go through the course of today's presentation. The last thing is we'll be sending out copies of these slides at the conclusion of the presentation. It usually takes a day or so to get those out. So don't feel like you have to take furious notes. We'll try and get you a copy of this particular documentation as well as a link to the recording if there's others that you would like to share it with. I'm joined today by three additional members of the Multnomah Group team. Scott Cameron, who is a principal and our chief investment officer. So he'll be talking a little bit about the market environment. I'm also joined by Greg Johnson. Greg Johnson is a senior consultant and is also the director of technical services at Multnomah Group. So he'll be talking about some of the operational and legal considerations for plan sponsors to be aware of. And last is Haley McLaughlin. Haley's a consultant and the chair of our vendor services committee. And she'll be talking about what we're seeing on the record keeper vendor side of the equation relative to providing resources and addressing the needs of plan sponsors during, obviously, this tremendously turbulent time. From an agenda perspective, we're going to leave it as kind of a Q&A. I'll do some questions. We'll take some questions from the remainder of folks here attending the webinar today. But we are going to get through a handful of topics, at least structurally, about current market conditions, addressing participant concerns about market volatility, which are reasonable and should be expected. I think we're already seeing a significant reduction in hours and headcount and what that means from a plan operational perspective, and the things that you should keep in mind when addressing your plan document during this time. We also know that many sponsors are taking extraordinary steps to trying to preserve cash during the outbreak and how that may impact retirement plan funding and decision trees that you may have to go through there. We'll also talk about fiduciary continuity and certainly what you need to do to partner with your service providers to leverage their resources at this point. So with that, maybe I'll open it up for a question for Scott as the CIO. Can you provide us maybe an update on what's happening in the markets currently?
Sure, Eric, happy to. So not surprisingly, probably for everybody, we've seen a pretty significant sell-off in stocks. Through Tuesday, the S&P 500 index was down about 22% year to date. Yesterday actually was a down day as well. So we're down through market close yesterday about 25, 26% in S&P. So large cap US stocks, and international markets are down slightly more than that. So we're certainly into kind of bear market territory as generally defined, with stock market declines of 20% or more. At the same time, we've seen a big spike in volatility in the market. If you have been paying attention, it's not been uncommon to see the Dow or the S&P 500 index move, 3, 4, 5, 6, 7, 10% on a daily basis, both down and in some cases up over the past few weeks. So if we look at the VIX index, which is a measure of volatility, we've seen a spike in volatility in the market to levels we probably haven't seen since the great financial crisis in 2008, early 2009. But if you look kind of within the broad market and look on a sector basis at what's happening, the market's kind of behaving as you would expect. So consumer staples and utilities on a sector basis have held up better. Those tend to be more defensive sectors. and sectors a little bit more sensitive to the market and kind of the current economic environment have done worse. So financials are down 32%. And energy is probably the big outlier, down 54% year to date. And energy has been driven lower primarily by the kind of dramatic decline in oil prices that we've seen over the past few weeks, in some parts related to the spread of the coronavirus and its impact on global growth, but at the same time, probably more directly impacted by the oil price war between Russia and Saudi Arabia that kicked off a few weeks ago. So, on a sector basis, what we're seeing is pretty much what you would expect to see in a market decline. Financials, in this case, energy, driven by oil prices, being the worst performing sectors. Consumer staples, utilities, and to a lesser extent, healthcare being better on a relative basis. The context, though, is, even with the pullback, it comes at the end of a pretty long and significant bull market that began almost exactly 11 years ago. We hit the bottom of the bear market from the financial crisis in March 9th of 2009. And since that time, we had 11 years of pretty good growth. And over that time, even with the 25% pullback that we've seen year to date, the market's up about 275% from that prior bottom. So, it is certainly the end of kind of this most recent bull market cycle. But even with the pullback, we've for long-term investors experienced pretty significant growth since the last bear market. Well, the market's been in decline. We've seen, really kind of there's two mechanisms, I guess, that we have to deal with the economy and the market. We have monetary policy led by the Fed and fiscal policy. And as is typical, I guess, in financial crisis, monetary policy tends to come more quickly. And we've seen that with the Fed's actions over the past few weeks. Last year, they had to cut interest rates a couple times to try and spur growth. But earlier this year, as this started to take hold more directly, the Fed moved quickly to cut rates once and then cut rates again so that the Fed funds target rate is at 0%. One of the challenges is that they were cutting off a relatively low kind of base rate. And so, we're somewhat limited from a rate cut perspective to go to zero. They've also launched a number of additional measures, including bond buying programs and a backstop for money market funds to try and preserve liquidity. I think this week we also saw the European Central Bank implement their own bond buying program. So we're seeing central banks both here in the US as well as abroad working to implement pretty aggressive monetary policy to try and provide liquidity to stabilize financial markets. Not surprisingly, with the rate cut, what we've seen is a pretty significant decline in yields across the yield curve. There was a time a couple weeks ago when, regardless of maturity, we saw Treasury yields under 1%. We've seen a little bit of a tick up since that time period, but if you look, 2-year Treasuries are at less than 0.5%. The 10-year Treasury, which is frequently a benchmark rate that many people track, is right about 1%. And 30-year Treasuries are at 1.63%. On a real basis, if you adjust that for inflation, what you're seeing is, negative real returns across all maturities of the Treasury yield curve. Declines in Treasury price or in Treasury yields are a result of bond prices going up, and we've seen that as there's been some kind of movement to safety, but it hasn't been more broadly felt in fixed income markets and particularly credit markets. While Treasury yields have declined, we've actually seen corporate bond prices increase, or bond yields increase pretty significantly, with the most dramatic increases being in low quality bonds rated CCC or single B. We're seeing yields up to 16.6%. So as markets have gone into kind of a very defensive positioning, credit, particularly lower quality corporate credit, has seen yields spike as prices have declined. To provide a little bit of context, though, if you look at kind of where that is, we're still not yet to kind of the yields that we saw during the financial crisis. So certainly it's a dramatic spike, but we aren't from kind of a context perspective, as bad as we've seen in a couple of recent scenarios that were more focused on financial markets and the challenges we saw in credit in the great financial crisis. So the market's been in decline primarily because of uncertainty about what's going to happen in the economy. So I think it's important to understand kind of where we were both from a global as well as a U.S. Economic environment. And what we've seen both globally and in the U.S. is that prior to the financial crisis, we were in a kind of a low growth phase where if you look at global GDP, most recently it was about 2%. That's been below the 3.5% average that we've seen this century. And if you look at the US GDP, similarly, we were seeing kind of a low positive growth environment. With that, if you look, it's likely that we're going to see some dramatic declines in economic growth. The first quarter number, may be flat to slightly negative. Much of the quarantining and the social isolation and the orders that have gone into place to kind of slow the spread of the coronavirus have gone in late enough in the quarter that they may have some impact on first quarter GDP where it's flat. But I think most economists are expecting second quarter to take a pretty significant hit and probably have negative growth in the second quarter, potentially into the third quarter, and then some recovery after that, depending on how all of this plays out. If you look at the components of GDP, it's pretty easy to understand kind of why that may be. If you look at U.S. GDP today, personal consumption is about 2/3, a little more than 2/3 of U.S. GDP. And we're seeing pretty dramatic pullbacks in personal consumption with travel, retail spending, restaurants, a number of areas that are pretty significant in the market. We're seeing cutbacks there. It's likely to have some trickle-on effect to business investment, which is about 20%, a little less than 20% of GDP. And what is likely to happen is, as the government puts together fiscal policies to try and stem some of the declines in economic growth that we're going to see as a result of this, is U.S. government spending will increase as a percentage of GDP in the near term as personal consumption and business investment cuts back.
It's a good point. If you look at what's occurred so far, we had the first COVID bill, which was really an appropriation bill. We had the second, which was signed last night, which is largely a unemployment disability extension of benefits bill. And I think the real question is the size of the third bill, which is currently being negotiated, which would be more of a direct intervention of aid and additional loan programs. Was listening in on a conference call yesterday that ultimately that particular program is likely to have a $1 trillion plus a sticker price on it, and with each passing day, that amount continues to grow. So it'll be interesting to see where that government GDP line ends up, once this all plays itself through. Hey, Scott, can you talk a little bit about on the participant side? So as plan sponsors, obviously. Participants are being impacted, both by the virus itself, obviously concerns about employment, but at the same time, their retirement accounts are likely being impacted. Any guidance you could provide on that side?
Yeah, it's as we look at it, I think it's really important to communicate with your participants and to focus on providing honest, clear communication to employees at times like this. As you mentioned, Eric, it's not just a market concern that we're seeing and how is my retirement impacted, but I think there's a lot of uncertainty as to employment status and prospects as well as general health of both themselves individually as well as their family and friends. So all of that kind of gets mixed up into a kind of a big pot of anxiety for many people. And I think the best way to deal with that is to communicate honestly and clearly and frequently to employees. I don't think it makes sense to kind of ignore the situation or just say, hey, keep saving, don't worry about it. But I do think it helps to communicate to them kind of in real terms what's happening, while also trying to provide some context. While you're doing that, I think, though, it's important to not get stuck providing investment advice. A lot of us as employers, want to take care of our employees and make sure that they're, doing the right thing for them and for their retirement. And so as you have those conversations, those communications, it's really easy to fall into the trap of potentially providing them investment advice. And as a plan fiduciary, you really don't want to be in that position of providing individual investment advice to your participants. So, I really encourage everybody that's in that role working with participants to utilize the mechanisms that they have in place to communicate and educate and advise participants. Your record keeping vendors have a number of resources, whether that be communication materials, recorded presentations, education tools online, as well as call centers staffed with professionals that can talk to participants about what's going on. Most plans also have vehicles for providing some level of investment advice to participants, whether it be target date fund vehicles, managed accounts, risk-based models. There are tools within the plan that should be used rather than trying to guess or forecast what's happening in the market. As we talk about communication strategies with participants, I think there's a few things that are really helpful to talk about. And one is to provide that context. I think it's important to acknowledge the situation we're in, but also provide context to them to help understand where that fits within kind of the broader market cycles. And so, this chart shows historical total returns for the S&P 500 index over the past, 20, 40, 30 years, as well as the max drawdowns that we saw in any given year. So in 2020, so far, we've seen a max drawdown about 29%. While painful, we're not in uncharted territories. You can go back to 2009, 2008, or the dot-com bubble prior to that and see that we had pretty significant pullbacks that were equal or greater than the pullback that we're seeing. And even as frequently as just a couple years ago, we saw an almost 20% pullback in 2018. So, it's very common that even in good years, and most of these years you'll see we end up in positive territory, we have pretty significant pullbacks intra-year. So the context of how the market has behaved is important. The other thing I think it's important to communicate is not just the decline, but the recovery. If you look at bear market cycles defined as 20% declines or more since World War II, on average, we've seen the market fall about 35% during those bear markets. So we're not even to kind of an average bear market yet in terms of the pullback that we've seen year to date. Those declines, can take a few months to, a couple years, but on average, we see a recovery that is relatively quick. It's averaged about 2.5 years to recover during those bear market cycles. So for most retirement investors, bear markets are painful, but from beginning to end, you're talking a 4-year cycle, a 5-year cycle. For retirement investors that are invested for potentially multiple decades, it should be, as painful as it is, a cycle that they can live through. I guess one caution with that is, one of the challenges of the current bear market is the fact that it's happened so quickly. It hasn't taken us a 1.5 years to go from where we were to the bottom, and I don't know if we're at the bottom yet. But the speed with which those cycles are happening seem to be picking up in pace, both on the decline and potentially, although it remains to be seen, on the recovery. in addition to communicating kind of the context of bear markets and declines, I do think it's helpful to provide kind of the long-term context of why are we invested for retirement. And if we look at the performance of the S&P 500 or stocks generally over the past 50 years, what we see is that as much as volatile as it is, and as significant of a couple of events that we've had, whether it be the current bear market, the financial crisis of 2008, 2009, the dot-com bubble in the early 2000s, or going back even to Black Monday in the late 80s, the market has shown growth. So $1,000 invested 50 years ago is worth almost $25,000 today, in spite of all those ups and downs. And that's why, as participants, we're invested in the market, is that we know long term, if we can ride through these painful cycles, we're rewarded as investors with growth. The other thing that we try and focus on when we communicate to participants is kind of the decisions that they make now can have a pretty significant impact on their growth of their portfolio and the prospects they have for saving for retirement. And this chart looks at the challenge of trying to time the market, and if you get that wrong, how that may negatively impact you. So if you look at $1,000 invested in stocks over the past 25 years, that would grow, if you were fully invested over that whole time period, to $4,127. As you start to take out and potentially miss some of the best days in the market, it doesn't take many days out of the market, if they're poorly timed, to have your returns cut in half. So if you miss the 10 best days in the market, your $4,000 is less than $2,000. And the challenge for us as investors is, as we've seen over the past couple of weeks, some of those best days in the market come, at unexpected times. We had last Friday, a 10% gain in the S&P and Dow. I think probably nobody had in their crystal ball was forecasting that, and obviously we've had negative volatility since then. But it's likely that at some point in the near term, the market will fully hit bottom and we'll have a bounce back. And for most investors, if they're trying to time the market, they're going to react too slowly. They're going to get out after we see the 25% decline in the market that we've seen this year, and they're probably going to wait to get back in until the market's bounced off that bottom and we've seen some pretty good returns. And that's that cycle of kind of selling low and waiting to buy back in it when the market's higher, makes investing very difficult to be successful. And then the last thing I would talk to participants about or try and communicate is, one of the challenges that we have with all the information that's available to us is we see market data every day. We're seeing the Dow Jones quoted, it's up 1,000 points, it's down 2,000 points, pretty significant swings there. You talk a lot today about the S&P 500. But the context for most investors is the market is not their portfolio. You may have a few investors that are very aggressively invested all in stocks, but if you look at most participants, they have a diversified portfolio. This chart looks at the total returns for target date fund series. In this case, I chose the Vanguard target date fund series because it's the largest target date fund family in the country. And if you look at year-to-date performance for the various vintages of the target date funds, what you see is the performance isn't as dramatic as what participants are probably seeing if they're following the news. So investors that are in the 2015 or the 2020 fund are seeing their portfolio down 10 to 13%. Certainly investors in the 2060, 2065 fund are down 22, 23%. So significant declines, but for most investors, especially those nearing retirement, the decline in market values isn't as dramatic as the news headlines may have you to believe. So I think it's really important that participants understand that context. It's certainly not, it's still painful to be down 10, 15%, especially as you're nearing retirement, but it isn't as dramatic as maybe they would feel if they were just following the news or watching CNBC and seeing what's happening in the market. market. So I think that context as well, both kind of the long-term performance as well as kind of what the current market is doing for diversified portfolios are really important things to communicate to participants to try and ease some of the anxiety that we've seen.
Hey, Scott, can you talk a little bit about what the investment committee is doing currently to try and support clients and participants?
Yeah, our committee continues to monitor, all the investment products that our clients have. I think we would caution any clients in a defined contribution context to try and take short-term in action from an investment perspective, but certainly monitoring the different managers that our clients have to understand exposures, monitoring the broad market, and putting together some communications that will be targeted for participants. I think we put together a couple of communications that plan sponsors could take and use with their participants to try and provide some context. We're also looking at having probably towards the end of this week or early next week a participant facing webinar that will be recorded that plan sponsors could share with participants that want to understand a little bit more of the context of what's happening in the market and how they should be thinking about their portfolio.
Thanks. Thank you. So Greg, on the technical side, I guess we've got a couple of things, right? Participants who likely are fearful maybe regarding their employment or wages or costs that they may incur, and then plan sponsors who simultaneously are concerned with the economic impact of a reduction in demand for services and how that might impact staffing and their preservation of cash. Could you kind of walk us through some of the issues that plan sponsors should be thinking about relative to those two issues?
Sure. Yeah, I'd like to sort of follow up on, excuse me, some of what Scott was saying about, retirement plan is meant for long-term saving, and we're in sort of what is hopefully, maybe according to its slides, maybe 2-year recovery, which in the course of retirement savings is a relatively short time. But the challenge that we face, especially right now when we've seen a significant downturn, is people begin looking for cash. And that's both plan sponsors and individuals. And that's sort of what I'd like to focus my comments on. And I think the two things that you're going to see from an employee standpoint is, begin trying to figure out ways to generate more cash. And one of the first ways to do it is to stop all plan contributions. They might do that because they need cash. They might do that because they don't want to see any more money going into the market. And I certainly understand the reasons that someone would do that. The only thing I would suggest to those people is that, one of the basic concepts of saving in a retirement plan is the concept of dollar cost averaging, which means you're buying at the highs and the lows. And if you stop buying at some of these lows that we're hopefully seeing right now, it can negatively impact your longer term savings. The other issue is if someone puts their contributions down to zero, especially if they have an employer match, they lose out on that as well. So, again, understanding that some individuals will feel the need to do that, it will have longer term impacts on your total retirement balance when it does come time to retire. The other thing that we always see in something like this, and really haven't seen it in quite this amount since the 2008-2009 downturn, but I think employees trying to get cash see the amount of money in their retirement plan and think, well, I'll go get some money out of there through a loan or a hardship. Again, understanding some people may need to do this, we would generally discourage against that. First off, if you're heavily invested in equities and you go to take a loan or a hardship, you're gonna have to sell some of those equities at potentially locking in a very significant loss that could negatively impact you. Even if you take a loan, you're gonna pay back the loan and you're gonna pay it back with interest. But again, if you were forced to lock in some of those losses to get that money out of the plan, there will be some opportunity costs that you will, that you might miss out on some of the market recovery. The other thing, if you're looking at a hardship, I think people need to recognize that hardship distributions are still taxable. So you're gonna have to pay taxes on that, and possibly even the 10% early withdrawal provisions. So, these are just some things that if you have employees coming, asking for access to the retirement plan, that they really should be made aware of. And I think most people would agree that a hardship in particular should really be considered a last resort. Yeah. The next thing to talk more directly to plan sponsors, and just some of the things again in the short term that you should probably be thinking of. But the first thing I would say is go get your plan document, go get your summary plan description, get any information that you're using to communicate about your retirement plan to employees, and review it, especially focusing on those hardship and loan provisions and what those rules are. Those rules, even though we feel that we're in a time of a bit of a crisis, it's still critical that you follow all the plan rules. We were talking about this yesterday, and a comment came up about some plan sponsors seeing employees in distress may feel that they want to provide greater access. If you do want to provide greater access and your plan doesn't allow it, don't do it. If you need to amend the plan to allow some access, then take the time to do it correctly. It's not a time to start violating plan provisions, because you still must follow those. The other thing that we may, I mentioned earlier, is people look for cash. One of the things that might happen is employer may seek to suspend or end their employer contribution. I would probably urge caution in doing that. Again, recognizing that some organizations may have no other opportunity. But if you are going to do that, again, make sure you're following the rules, make sure you're doing it right. So, think about the long-term impact on your employees' retirement readiness and their morale if you have to remove that benefit. Think about if you make a change to that contribution rate, what its impact will be on your plan participation and its possible impact on non-discrimination testing. Strongly encourage you to consult your legal counsel to make sure you're not violating any anti-cutback rules, and that no employees are excluded. If you've made a promise of a future benefit to them and try and pull it back, there will be ramifications from that. And also, depending on the type of plan you have, there are likely certain rules that you need to follow in communicating to those employees as you pull that back, as you pull that contribution back. So again, recognizing that this is a place where you might look on a balance sheet and say, I can generate some cash if I stop making this employee contribution, I would do so carefully. The last thing in the short term for plan sponsors that I had is, just think about if you're reducing staff, especially hourly employees, how you calculate hourly employees, and whether it will impact any of their eligibility for the plan, and also whether the number of participants goes down. I think it is even important to think about, even with no changes in the contribution rate, depending on the employees that are either no longer employed or maybe have reduced hours, how that can impact your non-discrimination testing as well. So
sorry.
Go ahead.
No, just to echo, Greg's comments. I think from a participant perspective, we've already seen, even prior to this particular issue, an increase in hardship withdrawals just brought about by some of the changes in regulations. So it feels inevitable if unemployment is on its way to 10% or greater, that we're going to have a lot of pressure on distributions, loans, and hardships. We are working through an additional webinar potentially in the next week or two where we'll get into some of these issues. But as it relates to loans, there's been a lot of work with employers to restrict the number of loans. What you could very easily see is employees who have maxed out their loan cap. Those tend to be more at-risk participants, and they may be limited by your plan document. Hardship, certainly the rules that Greg indicated. And then on the employer side, while we haven't seen, obviously, in this short period of time, necessarily a move to amend retirement plans, what we have seen in some industries is pretty significant reductions in headcount, many organizations are going through contingency plans. And one of the things that we certainly would encourage you to take a look at is if part of your contingency planning you to suspend the payments in the future, right? So if the contingency doesn't arrive or trigger, it doesn't create that necessity. But if you wait until the last moment to make those amendments, the notice requirements and the anti-cutback things that Greg mentioned are things that may prevent you from triggering that cash preservation strategy. So again, whether or not you intend to use those triggers, or certainly hope to not have to use those triggers, if they are part of your contingency planning to try and address this reduction in demand, you would need to work those through now to give you the maximum amount of flexibility. Hey, Greg, can you talk a little bit about what the Technical Services Committee is doing in light of what is a pretty rapidly changing regulatory environment?
Yeah, I think the thing that I'm probably keeping an eye on most is, any actions by the government relative to retirement plans. We've already, we've seen some action relative to not filing income taxes. You still need to file them on time. But for those people who owe, have a 90-day extension to make payments. It's common when you see a natural disaster for some type of relief, maybe allowing hardship distributions in the particular affected region. I don't know if the government will do something relative to that. I have my own opinions on whether that's a good idea or not. I don't know that opening up the entire defined contribution system in the nation to allow everyone to begin taking hardship distributions as a result of this is the best course of action, given the potential impact on defined contribution savings long term and the importance of this savings to everyone's retirement. So I can't really say whether that'll happen or not, but it's certainly something that we've seen in more localized natural disasters, and certainly I would think would be on the table.
Thanks, Greg. Hey, Haley, could you kind of talk about what we're seeing on the record keeping vendor side, and how that might impact plan sponsors?
Absolutely, yeah. So broadly, we're seeing two things from record keepers. First, these large financial institutions have long had business continuity plans in place for times of emergency, and we're seeing those enacted with large numbers of the workforce for these companies working from home and doing their best to protect their employees while also maintaining the service levels that we expect. We're hearing a pretty wide range of work from home rates for these companies. I've heard anywhere from 20% to 90% of their workforce working from home, which is a real test of those business continuity plans and the investments they've made in the technologies to be able to do things more remotely or through more automation. So a big test of what these companies have been planning for. Second, record keepers are also working to address the evolving needs of clients given the market conditions. We're hearing an increase in participant calls as well as an increase in transactions, which would be expected. Anecdotally, one of our record keeping partners told us last week that they had seen an increase in calls to the call center of about 20% more than they get on average this week. On Monday, they received the same number of calls that day that they expect to receive in an entire week. So certainly an uptick in participants reaching out to those record keepers to just check in, to talk to someone, or to make transactions and changes. Both of these things have combined and have some impacts both on participants and plan sponsors. For participants, you're likely to see an increase in hold times for those call centers as volume, and then also potentially reductions in the headcounts of the people working those call centers. We've also heard from several record keepers that they're working to update messaging on their websites and then also on hold announcements about the market conditions, including details of what can be done online instead of on the phone, and just sort of calming reassurances about the market, much like what Scott gave us earlier in this presentation. We're also seeing a limit or no in-person education sessions and one-on-ones, which is to be expected. Many record keepers have been investing pretty heavily in their technology resources to do some of those meetings virtually. So we'll continue to monitor to see which record keepers are doing those virtually and still allowing participants to talk to someone. For plan sponsors, the impacts are less drastic. Broadly, we're seeing relationship managers limiting in-person meetings and travel. So those committee meetings might be virtual instead of in person. But something to think about is if you have a change currently underway, whether it's a fund change, an investment menu change, maybe fees, or a contract conversion, it might be prudent to look at delaying or extending that time frame for the change. The current climate may limit the kinds of communication and education you can give to participants around these changes, and you may have other priorities for communicating to staff at this time. So it's important to work with your record keeper partner and your consultant to come up with the best plan to move forward. In the meantime, you're undoubtedly relying on your record keeper partner to provide some pretty essential services to your plan. As Greg mentioned, the fiduciary requirements don't stop during this time. You still have to do all of the things required of your plan. So we put together a couple of upcoming deadlines that have not been moved. So for 403B plans, March 31st is still the date for those plan document restatements that we've been doing for the past few years. For calendar year plans, July 28th, if you made a change in 2019, July 28th is the date for a summary of material modification or a new summary plan description to go out. And then, of course, July 31st is technically the due date for the 5500 without an extension. Of course, you can extend until October 15th automatically. So something to think about. There are, of course, other ongoing requirements. If you've got a change going through, participant notices are still required. If this is the time you're usually doing, for example, universal availability or fee disclosures or anything like that, it's still a requirement. You're likely handling some non-discrimination testing. We certainly may see an increase in those hardship and loan processing and audits.
It's a good point on the audit side, Haley. So for you that are calendar year plans subject to audit, I think increasingly we've seen audit activity recur remotely, but reaching out to your audit partners, because I think there's some uncertainty as to how long the social distancing and working remotely would last. I think certain auditors have been much better prepared to conduct their work remotely. Others have relied still pretty heavily on location-based audit work. So trying to determine and structure that ahead of time so that you've got some rules of engagement, and even for those providers that may not have been as apt to provide that service previously, pushing them in that direction. So Haley, can you talk a little bit about what the Vendor Services Committee is working on to support clients?
Absolutely. So as Greg mentioned, we are waiting to see if the government makes any changes, and we will continue to monitor that situation as well as what our record keeping partners do with any of those changes. Additionally, if you're like me, you've probably received a ton of emails from vendors and other parties with their response to what's happening. Under that avalanche of notices, it's pretty easy to let things slip by or get lost. So we are working with our largest record-keeping partners to pull together all of the resources that they're creating, both for plan sponsors and participants, and we will get those to our clients as they're put together.
Thanks, Haley. So I wanted to open it up to questions, so I'll give folks a chance to type some through. Scott, I've got one for you if you're there. Should participants and investors sit tight with what they currently have and kind of trust that everything's going to bounce back, or should they be shifting investments to something more conservative in this current market environment?
Yeah, good question. Pretty common question we're seeing. I think, hopefully everybody had a portfolio that was appropriate for their time horizon, their risk tolerance, and their investment objectives. And if that was the case, I think it generally makes sense to kind of hold firm to that. Certainly it's a painful bear market, but bear markets are the normal course in the stock market over the long term, and those focused on retirement should expect that we're going to see these from time to time. Obviously, the nature of what's causing this is somewhat unexpected. And unusual and different from what we've seen previously, but the fact that we're in a bear market shouldn't be surprising to anybody. So, to the extent that you had kind of a well thought out investment allocation kind of going into this, I think it makes sense to hold and stay with that. For many people, this is a test of that the perceived risk tolerance that they had. Your risk tolerance frequently when the market's doing well seems to be higher than what it may be in a 25% market decline. If that's the case, I think it can make sense to kind of rethink and potentially pull back a little bit on your overall allocation. But I would caution a couple things. One is the market's already done that for you. So if you had a traditional, 60% stock portfolio, you don't have 60% stocks today. You have less than that. So the market's already kind of made you more conservative in your allocation. And two, I think it's hard to differentiate between kind of is this a reasonable pullback to something more conservative based on my long-term objectives, or is this kind of a reaction to the market? So I think you can consider potentially pulling back a little bit if you're finding that you're not in the right risk tolerance. But I would really caution against any broad sell-off and move to cash or liquidation of your portfolio. I think you're better off to kind of ride through the market, and as things kind of stabilize and normalize, better evaluate your risk tolerance then and make adjustments to the portfolio.
Here's a question I'll take. What tools from an employer perspective are available for employers who are trying to conserve cash and maintain employment? I think there's a few things that employers can look at in having done contingency planning for clients in the past. I think the first is, if you have mandatory contributions, at least changing those to discretionary. So for instance, if you're a safe harbor plan, you have an opportunity at mid-year to opt out of that, which may make sense. In other cases, employers may be making concurrent contributions to a retirement plan. If your plan document allows for it, you could change that to a contribution at year end as opposed to concurrent if you're trying to conserve cash. And then clearly taking anything that's a mandatory contribution and making it discretionary, I think are all potentially viable methodologies, again, in a contingency planning scenario if you're working through that. Have another email coming through, which companies are sending multiple emails about the evolving COVID-19 situation. Are you seeing plan sponsors sending additional communication specifically on market volatility and retirement plans? Could it result in more anxiety in the employee base? I think it's a great question. I think we're seeing a couple of different approaches. I think in some cases we are seeing additional communication. I do ultimately think that to Scott's earlier comment, the level of anxiety that's currently out there is such that this probably doesn't have a tremendous amount of impact. I think if anything, it's getting crowded out by so much additional messaging. So our initial communication was with plan sponsors to say, here are some tools if you're getting those kind of inquiries, rather than necessarily pushing it, because at this point, I think it's difficult. I do think as we settle into an extended period of time where more and more employees are working from home, creating more available content and resources for participants is going to be critical. So that not necessarily we're pushing it to them, but creating a resource environment where those that may have the time to think about these issues have a place to go at a time that's convenient in the setting of their own home. Additional question. This is do you think the administration / Fed is doing a good job right now? I think that's an eye of the beholder type question. There's very limited things the Fed can do, which we've talked about in prior meetings with clients. I think reducing the lending rate to 0 certainly makes sense. I do think the Fed's mandate is full employment and low inflation. It's really clear that this is going to have a tremendous impact on employment. And I think the Fed has a role to play in trying to mitigate that to the extent possible. I think, what we get out of this third, as it relates to the market impact, this is separate and aside from, public health issues, which I'm not qualified to speak to. But as it relates to, how ultimately is policy impacting the economy, I think that largely is going to come down to this third COVID bill, and what other additional bills may come. I think that it seems unlikely to me that the third bill will be the only bill. There may be more bills after that. This is going to be very, very painful for at-risk communities, and I think it's already had an unprecedented impact in my lifetime, an unprecedented impact on demand. So it's going to require a lot of aggressive action, and only in hindsight, I think we will be able to determine whether, from an administration and policy perspective, we did enough / the right thing. So with that, I'm going to close it up. If you have additional questions, please do feel free to send those along. We're happy to answer them and respond back to get information in the hands of folks. Feel free to reach out to myself or any of the panelists directly. Again, we wish you all good health, and please let us know what we can be doing to help support you and your organizations. Thanks so much.